Have you ever looked at a company and just wondered, what is really going on in there? Well, today we're pulling back the curtain on business finance. And by the end of this, you'll have the tools to look at any company's numbers and answer one really big question.
Seriously, how do you actually know if a company's firing on all cylinders or if it's just, sputtering along? From the outside, it can be pretty much impossible to tell. To get the real story, you kind of have to play doctor, a financial doctor, that is. You've got to perform a complete checkup, looking at the core numbers that show what's truly happening under the hood. And just like a doctor checks your pulse, your blood pressure, and your temperature, we have 3 core vital signs for any company. These are the profit and loss statement, the balance sheet, and the cash flow statement. Put them together, and you get a really clear picture of a company's financial health.
Okay, first up is the performance test. This is all about finding out how the company has been doing over a certain amount of time, like a quarter or maybe a whole year. And for that, we turn to the profit and loss statement.
So what is it? The P&L, sometimes called the income statement, is basically the company's report card. It adds up all the money that came in, subtracts all the money that went out, and gives you the final score. Did they win with a profit or lose with a, loss?
And the journey to find that profit is actually pretty logical. You start at the top with total sales. Then you take away the cost of actually making the stuff you sold to get your gross profit. After that, you subtract all the other costs of running the business, like rent and salaries. And finally, after you deal with interest and taxes, you hit the famous bottom line, your net profit.
So, let's say a company has a net profit of 6 lakh rupees. That looks great, right? They're making money. But this is where things get really, really interesting.
How on earth is it possible for a company that's officially profitable on paper to just suddenly run out of money and fail? Well, the answer lies in the huge difference between profit and something that's way more important, actual physical cash.
To solve that little mystery, we need to check the company's true lifeblood. It's cash. And that brings us to our second vital sign, the cash flow statement.
Now here's the key difference. A cash flow statement doesn't care about accounting rules. It only tracks one thing, real cash moving in and out of the bank. It's the ultimate reality check that connects paper profits to cold, hard cash.
It breaks all this movement down into 3 big buckets. Operating activities, that's cash from your main business. Investing is cash you spent on big assets, like a new factory, or maybe cash you got from selling one. And financing, that's cash from investors or banks. This tells you if the company is funding itself with sales, or by selling off its stuff, or just borrowing more money.
All right, so we've checked the company's performance over time with the P&L, and we've checked its lifeblood with the cash flow. Now it's time for a physical, a snapshot of the company's condition at one single moment in time, and that is the balance sheet. Think of it like a photograph. It just captures what a company owns, its assets, and what it owes to other people, its liabilities, on one specific day. It's all about its status right now, not its performance over the last year.
And right at the heart of the balance sheet is this one simple, unbreakable rule. Everything the company owns, its assets, had to be paid for by one of 2 things. Either money it borrowed, which are liabilities, or money its owners put in, which is equity. It always has to balance out. That's why they call it a balance sheet.
So now we have our 3 vital signs. But a bunch of raw numbers on a page, they don't really tell you the full story, do they? We need to actually interpret them. This is the doctor's diagnosis part, where we use financial ratios to get some real insight.
Let's go back to that 6 lakh rupee profit. On its own, it sounds pretty impressive. But what if I told you that it represents a 12% profit margin? Now that number gives you context. It tells you that for every 100 rupees in sales, the company keeps 12 rupees as profit. See? Ratios are what turn raw data into actual intelligence.
Ratios help us answer some really simple but absolutely critical questions. We're going to look at 3 of the big ones: its liquidity, its profitability, and its solvency.
First things first, liquidity. This is all about short-term survival. Does the company have enough cash or things it can turn into cash quickly to cover all its immediate debts?
The most common way we check this is with the current ratio. And it's a really simple calculation. You just take all the company's current assets, that's stuff like cash and inventory, and you divide it by its current liabilities, which are just the bills it has to pay within the year.
So what's a good number? Well, a ratio of 2 to 1, for example, means the company has 2 rupees of ready assets for every 1 rupee of bills coming due. That's a pretty healthy cushion. A ratio that's below 1, though, that could be a major red flag. Okay, next up, profitability.
This goes a step further than just asking if it made a profit. It asks, how good is it at making a profit? Out of every single sale, how much actually sticks around as profit?
And for that, we use the net profit ratio. You just take that bottom line profit number we saw earlier and divide it by the total sales. And that gives you that powerful percentage we were talking about, showing you how profitable its main business really is.
And finally, let's talk about the long game, solvency. Basically, we want to know, is this company standing on its own 2 feet, or is it heavily leaning on borrowed money to stay afloat? The debt-equity ratio gives us a crystal clear answer. It compares how much long-term debt the company has versus how much money the owners themselves have invested. A really high ratio means the company is being financed more by bankers than by its owners, and that can be pretty risky. And there you have it. By combining these 3 statements with just a few key ratios, you can go from just looking at a company to truly understanding it. You now have the Financial Doctor's Toolkit. So the only real question left is, which company are you going to diagnose first?